Hello, everybody. Welcome to this webinar that is titled Leverage Your Investment Portfolio with Share Margin Financing. So this webinar is brought to you by Bursa Malaysia and managed by our company, LifeCham. So my name is Shen Chu and the moderator for this session. So welcome, everybody. Now, this session is a pretty advanced topic because if you are really new to investing, share margin financing would probably blow your mind, and it's probably a bit more of a risky instruments for you to leverage your portfolio. But it's okay if you are a new beginner here. It's okay there for you to learn first. It's important for us to understand the concept of leverage, what are do's and what are don'ts, and what are the risks when it comes to using it, and what are the benefits if we use it correctly. If the market goes in our direction, then it can also help us to amplify our investment returns. So today we are going to look into what exactly is share margin financing and how we can use it to amplify our returns, and what are the risks when it comes to using this product with this facility offered by the financial institutions. Before we begin, as usual, disclaimer: whatever we share in this webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Now, allow me to introduce our speaker today, and he is the founder of EECameron, Mr. George Paul. Now, George graduated with a bachelor degree in finance from Coventry University, UK. He is a licensed financial planner. He's also a financial advisor's representative. He's a co-founder of EECameron with sharing contents of more than 1 million views. He has more than 9 years of investment experience and has trained more than 1,210 working adults to master the wealth growth strategy in 3 years. And he formulated the wealth growth strategy. So today we are very honored to have you here with us, George. How are you?
Hi, Shen. Thank you for having me. So everyone can hear me?
Yes, can hear you. Nice and clear.
Great.
All right, so let me stop sharing my screen and hand over the control to you.
Okay, sure. Thank you, Shen, for the sessions. So let me just kick start off my sharing today. So can everyone see my screen now?
Yes.
Okay, perfect. So as the disclaimer and the introduction goes by, I will just stop. I will just skip this, right? So let us go straight into the learning outcomes of today's sharings. So as Shane mentioned just now, this is a quite advanced topic that in investment. All right. So in this today's sharing, I will briefly tell you what is share margin financing, just the concept itself, and how we can leverage it on our stock portfolio, and what the don'ts do and don'ts using share margin financing, right? So before I started talking about share margin financing, I have a few questions to ask, right? So when we talk about personal financing products offered by the bank, often people will think about mortgage loan, hire purchase, right? Personal loan and credit cards, and all these are the loans products. So let us have a look on this, right? Mortgage loan, what it is about is to finance the purchase of real estate. As simple as that, right? So hire purchase is to finance the purchase of vehicles, our cars, vans, and anything else, the moving vehicles. And for personal loan, it is to provide an unsecured financing to all the individuals. And credit card is to advance the finance of purchases. Now, today we are talking about share margin financing. It is also one of the personal financing products offered by the bank. But what it is about, right? So it is to finance the shares investment and trading activities of the investors. Now, many of you may heard of share margin before, right? But let me just do a head count, right? A simple head count. How many of you know how to use share margin financing, or you are using share margin financing? You can just put into the chat box with I am. You can say I am, or if you're not, you just say no, right? I just want to catch how many of you here know how to use share margin, or you have the idea of what is share margin financing, right? So I can see most of you don't have the don't know how to use share margin financing, or you don't have the privilege to, get in touch with share margin financing. But don't worry, I will tell you the concept today and also share with you how we can leverage it to our portfolio. All right. So what is share margin financing? Okay, in the official definition, it is a standby revolving credit facility which provides leverage for the secure collaterals for trading, subscription, or purchase of securities. Now, in this official definition, I know it's a long sentence with a lot of jargon, right? But a few keywords here. It is a standby and revolving credit facility. That means you apply once and it is revolving, right? It is not like a mortgage loan or a hire purchase loan. You apply for a car, and then after you have, fully repaid the loan, then this facility is considered completed. Then whenever you want to buy another car, you have to apply for a new facility. But for share margin financing, you apply once for an account, and then you can continue using it so long that you don't exceed the limit, right? So this is the first key point. Okay. So second thing, it provides leverage. Now, whenever we talk about investment in shares, we always think about you can use your cash. So how much cash you have in your account, that's the limit that you can use. Or some of your dealer or your reminder will give you some contra or some additional trading limits, then you might use that account for maybe T+7 or T+9, something like that, right? But for share margin financing, you can leverage on the bank itself or on the financial institution itself to give you additional trading limit to trade. And it's not limited by a trading days, for example, T+7 or T+9. You can use it so long that you can pay for the interest, right? Fair enough. And it is a secure collateral now. It's secured by the shares itself, okay? And for what purpose? It is for a trading or purchase of securities. Now, I know this one sentence can break out to 3 main points, but in layman terms, it is a loan that takes shares portfolio as collateral for the purchase of shares, right? So it's very simple. This is illustration that I wanted to share with all of you. Now, so on the left-hand side is your shares portfolio. You pledge it to the banks or the financial institutions, and they will give you a loan or a financing facility to trade and to buy shares. So at this juncture, everyone can get what I mean, right? And do you have a brief idea of what is share margin financing? Now, to make it more clearer, I put a comparison between share margin financing and a mortgage loan, right? So for share margin financing, it is to finance the share investment, while the mortgage loan is to finance the purchase of property or investment of property. Now, in mortgage loan, we know that you can always leverage up to 90%, or if you are a first home buyer, you can get up to 100% financing. Now, in share margin financing, I would just tell you that it is with a higher multiplier, higher multiplier. But what is the margin that you can utilize? I will show you later. And one of the biggest difference between mortgage loan and share margin financing is that in mortgage loan, there is a fixed repayment term, that you can loan up to 30 years. And then it fixes you with a monthly repayment terms. But in share margin financing, there's no such thing. There is no fixed repayment terms whereby you need to service your loan every month. Now, I know this might be a little bit fresh or new to you, because you think that, is there some loans that I don't need to, service every month? Yes, there is. And its name is share margin financing, right? I will tell you why. And the interest rate is a little bit higher than mortgage loan, all right? And mortgage loan, as everyone know, now we are in standard best rate plus with the spread, all right? But in the market, the share margin financing is always higher interest rate than the mortgage loan. And last but not least, both of these facilities are offered by banks and licensed financial institutions. So not everyone have this facility, but some banks or some brokers, they do offer share margin financing. So if let's say you already have an trading account with your brokers, you might just ask them, you don't need to apply it, but you can just ask them, do this broker offer share margin financing, or do the bank offer the share margin financing, right? Now, after we have known all about this share margin financing, let us move on to, the benefits and some weaknesses of share margin financing. Now, we call it the pros and cons of share margin financing, right? Now, the pros, okay, of share margin financing is that, okay, it provides leveraging on your investment portfolio. Now, I will just give you some example along the way, during my explanations, so that you won't feel boring, because it's quite wordy, I know. All right. So when we say about it give you a leverage on your investment portfolio. For example, today I have a share portfolio of around, let's say, 1 million value of share portfolio, and I don't want to sell my shares, in order for me to get additional trading limit to buy shares. This portfolio of mine of 1 million is all the portfolio that I want to keep it, but I want additional trading limits. How can I do that? So I apply for a share margin financing. I talk to my banker. I say that, okay, can I just pledge this 1 million shares with you, and then can you give me additional trading limit for me to trade without selling my portfolio? And the banker will tell you, yes, we can. So you can leverage on your portfolio to get additional trading limit to trade. So later on, I will also share with you how do we calculate on it. All right, just bear with me, all right, for a few more minutes. Okay. So second thing, it can improve your ROI. Okay, ROI in short term is a return on investment. How can we do that? Now I give you a simple illustrations. Okay, if let's say you have a paper and pen with you and best with a calculator, you can do so, right? So for example, today you have a million worth of shares, and this company is going to give a dividend of, let's say, 5 cents per share. Now this 1 million of shares maybe is a 1 million shares. Okay, put it in a simple way, it's a 1 million shares. 1 million shares with 5 cents, you can get how much? Your dividend. But today, if let's say you pledge your portfolio of this 1 million and you buy additional, let's say, 500,000 shares of this company, today you can get dividend of 5 cents per share for 1.5 million shares. Now, how much is your cost? What is your cost? Your cash injections of this investment is only 1 million, the one that you buy with cash. And the additional 500,000, you get it from the banks, for the share margin financing. So it's not from your own cash. So you see, with 1 million cash, you can get additional dividend income for your investment, right? And thirdly, is flexibility in repayment. Okay, so as I mentioned just now, there is no fixed repayment term for share margin financing. So it's flexible. Whenever you feel you want to pay it, you can just do so. All right, but there's something called margin call and forced selling in this share margin financing. Okay, so later I will share with you what is the situation or in which circumstances that you will hit margin call, and that's the time the bank will demand for a repayment. And other than these two situations, you are free to decide whenever you want to repay the money or not. Okay. Now, fourth is seamless trading experience. Because share margin financing is linked directly with your trading account. So there's nothing like the bank give you cash and then you have to take the cash to bank into your trading account and to trade. It's quite troublesome. So the bank or the broker will link directly for your share margin account with your trading account. So it's quite seamless, experience for you and for the investor. And the last points of share margin financing is that it accepts wide range of collateral. Now, when we talk about share margin financing, we always think that, okay, I can only pledge my shares. And some people will ask, can I pledge my house? Or can I pledge my cars? Some even talk about, hey, can I pledge my unit trust or what else? Okay, so it depends on all the financial institutions on the collateral that they can accept. But most of the financial institutions that offer share margin, they will take shares, they will accept cash and also fixed deposit. Okay, some of the banks they do accept unit trust and whatnot, right? But most of them they will just stick with shares, cash, and fixed deposit. Now, if you think that share margin sounds very interesting and it sounds so good, now let us look at the cons first. Okay, it is a double-edged sword because it can leverage on your portfolio to improve your return. If you use it wrongly, it will increase your losses as well. So that's what we call it's a double-edged sword. So you need to know the mechanism on how to utilize the share margin financing before you use it. Okay. So as my second point goes to, right, it is potentially will increase the losses, and sometimes there will be a technical issue with your brokers. For example, if let's say you are getting the financing from a bank, which is not the same with your broker, right? Then there might be some technical issue in between. Whenever they have some sharing of information. For example, you bought shares yesterday, but those shares are not sent to the banks for reconciliation. So the banks cannot allow you to have a trading limit this morning. So this kind of situation might happen when you have different financing providers and your trading accounts. Okay, so these are the disadvantages of using share margin financing. Okay, so far so good, right? Then I will just move on to a types of share margin in the markets. All right. So there are two types of share margin financing in the market. I just put it into a simple term, right? One we call it as an internal margin, and another one we call it as external margin. So what's the difference? You can see the words highlighted in red, right? So internal margin means the stockbroker itself is the financier. So if let's say you are with for example, I will show the providers later on. Okay. So for example, you are with broker A, and then broker A also provide and offer share margin financing. So you get the financing from broker A. So you are consider using internal margin. Okay. And if let's say you are getting the margin from a bank, and also your trading account is different from this bank, that is considered as an external margin, right? We call it offered by a third-party financial institutions. Now, what is so good about share margin financing is that some of the financing may not appear in your secrets or your CTOS. I know some of you might think, oh, is that possible? Yes, it is, right? Because as everyone knows, whenever we are using a financing, we are getting a financing from a financial institution, it will show in our secrets or CTOS, right? So the banks, whenever you get another new loans, from another banks, they will know that what are the financing that you are existingly held in your personal name. But if let's say you are using some share margin financing with some stockbroker, they might not need to register your financing into the secrets. Okay, so bear in mind this is quite important. If let's say you are with a tight, gearing, then you may not want to have the share margin appear in your secrets, right? Now, here's an example of the internal margin providers. As you can see, it's a lot of the investment bank in Malaysia. Okay, just quote some few names. We have Kenanga Trade, we have a Hong Leong Investment Bank, Rakuten Trade, CGS-CIMB. They are one of the stockbroker. Affin Hwang, RHB Investment Bank, Maybank, TS Security Public Investment Bank, and whatnot. Right. So these are some of the internal margin providers in the market. And you can see there are quite a lot of providers, right, for internal margin. And what about external margins? Okay, so in external margins, we have not many, but right now in the market, as I know, there are only two. One is Hong Leong Bank and another one is Alliance Bank. Now you might see the same name in internal margin and the external margin, right? So let me just go back to the slide. Okay, so this one, the internal margin is offered by Hong Leong Investment Bank, and the external one is actually offered by Hong Leong Bank, the commercial one. So it's different entity, all right? So they do offer external margin for you to trade with your own stockbroker while you can get the financing from the bank itself, right? Sound interesting, yeah? So internal margin, there's not much of the explanation that I need to tell you because it's quite simple as the name it is, right? So you just apply with the broker and then you can straight away have the margin itself. Now I want to highlight on the external margin because of the reason I will tell you later why I focus more on external margin, right? Okay, so first as an investor, now you put everyone, okay, I use a very nice photo here, you as the investor. Now, when you want to go to apply share margin, you go straight to the financial institutions. And then when your share margin financing is approved, your facility is approved by the bank, then they will connect with your stockbroker itself. So you don't need to go and tell your stockbroker that, okay, I already got my share margin approved. So can you go and talk to my bank? You don't need to do this step. The bank will deal directly with the stockbroker itself. And once this step has been done, then the stockbroker will update your trading limit from the financial institution. And every day, every morning, you can see you have a fresh trading limit, shown or reflected in your trading accounts. So this is the mechanism, for the application of share margin financing and how is the trading limits being reflected in your trading account. Well, along my way, you can ask any question, just put into Q&A. I will answer it at the end of this sharing. So next, when we talk about application, it's quite easy, right? Then how about if let's say we want to buy or sell some shares inside my using my share margin account? How will be the payments, or the interest being counted, right? So once the trading limit has been go to you, okay. Then for example, you say, okay, today I want to buy shares, A shares on stock A. Okay, you just click buy in your trading account. Then your stockbroker will compile the transaction that you done in today, and then they will send it to the financial institution, to the financial provider. So they will send it to them and request for payment on T+2. Okay, so this thing you don't need to worry. Okay, we will still the bank itself will still follow the T+2 payment date set by Bursa Malaysia. So the bank will then have to pay the money to the broker. So you don't need to worry about, do I have to pay the money to my broker, or do I have to instruct my banks, to pay the money to the broker itself? You don't need to do that because once the transaction has been sent to the banks, they will do a reconciliation and then they will issue the payment to your trading account, right? And then when the banks send the money to the stockbroker, they will add this amount into your facility as an outstanding balance. Okay, so outstanding balance equal to the loan that you took from the banks, and the interest will be counted and will be calculated based on the outstanding balance. Now, I'm not sure whether it is too technical for you all to digest this one, right? This thing, okay? But it's quite simple. When you buy and sell the shares, the broker will deal directly with the bank and they will just add it into your outstanding balance. So for example, today you sell some shares, right? So the broker will send the money, back to the bank. So the bank will offset your outstanding balance. Okay, simple as that. Okay, all right. So at this moment, is everything considered okay? If let's say okay, I will just proceed with my sharing. All right. Okay, there are 4 components of share margin financing that you must be aware of. Okay, I put it into a more precise term is that you must understand all these components before you started to use it. All right. So the first thing is the interest rate. Okay. So the interest rate will be charged on your total outstanding amount. And today it is based on standard base rate plus the spread from the bank. Okay, so it will be on your interest rate. The second component is the multiplier. Okay, so multipliers are varies based on the collateral. It's usually range from 1.5 times to 2.5 times. Okay, now how do we calculate it, right? I will show you later, don't worry. And the third component is margin of financing. Okay, so margin of financing is, so for example, just now when we talk about mortgage loan, we said that, okay, the margin of financing up to 90% or 100%. Okay, so margin of financing is actually the amount of money that the bank allowed you to borrow from your loan in percentage terms. So for share margin financing is typically or usually between 50% to 60%, right? But bear in mind, your collateral is different with the mortgage loan. Because for the mortgage, right, your collateral value is fixed at the beginning of your facility. Now, whenever you apply, you say, okay, this house is worth 1 million. So the collateral value is fixed at 1 million. But for share margin, because the share price, fluctuate every day. And sometimes you will just buy and sell every day as well. So the collateral value is fluctuated, fluctuating according every day. So this margin of financing is also varies every day. So it will change. Maybe today it will become 50%, and tomorrow it will become 60%. Okay. So these are one of the main component of share margin financing, which most of the investor, they will get confused of it, right? And last but not least is margin call. So margin call is a request from the bank, to demand for your payment. Now remember when I said there is no fixed repayment for share margin financing except for two circumstances, which we call it margin calls. So when you hit certain level of a margin, then the bank will call you for the money or for you to top up the loans. Okay. Now these are the four main components. So I will go back. I'll go straight into some real life example, which I snapshot some of the information from the product disclosure sheets available online. Okay, so now we talk about margin of financing, which this is the thing that I mentioned just now. A lot of people get confused of it, right? So this is the snapshot I take from Hong Leong Bank share margin financing product disclosure sheet. Okay, as you can see, the margin of financing that they offer is up to 60%. And how they calculate it? Okay, so the calculation will be the total outstanding balance minus, okay, or deduct the fixed deposit that you pledge with the bank or the cash that you put into your facility, divided by your total collateral value. But remember, there's an asterisk over there. Okay, so the maximum outstanding balance that you can have, okay, is equal to the total collateral value time with your MOF. Okay, I know you will get confused anyway. So the total collateral value, why they put in an asterisk over there, is because it will fluctuate based on daily prices. Okay, it will fluctuate, so it's not fixed. Okay, now let us move on to the trading limit. Okay, just like I mentioned about the multiplier, so I will go into the trading limit. So give you more, give you a better image, better picture of how the calculation being calculated, right? So for example, today you pledge in fixed deposit or cash for your facility. So for example, today the bank offer you with 2 times of the multiplier. It means when you pledge in 100,000 of fixed deposit for your facility, you will get a 200,000 trading limit. Okay, so it's quite simple, right? It's quite simple. So for stocks, for example, if let's say the multiplier is 1.5 times, so your stock value today is worth 100,000, the bank will give you a trading limit of 150,000. Now this is quite simple calculation. Okay, so it depends on the multiplier of the bank's offering. So if let's say the bank is offer 1.5 times for the fixed deposit, that means for every 100,000 of your fixed deposit pledged with the bank, you can get 150,000 trading limit, right? So if let's say for stocks, they they lower down the multiplier to 1 times. So that means whenever you have a stock value of 100,000 pledged with the bank, they will give you additional 100,000 trading limit. Now, this trading limit, I forgot to add on one word in front of it, is additional trading limit. Okay, so it will not sell down your shares. It will not sell down your, withdraw your fixed deposit that you pledge with the bank. Okay, your fixed deposit will sitting in the bank to earn the interest. while the bank will still give you the additional trading limits for you to trade. Sound so interesting, right? Okay, now let us move on to the third point that I mentioned just now, which is the margin call, when the bank will ask you for repayment. So this one I need all of you, to pay more attention to it, because this is the time when you will get frustrated when the bank calls you and say, hey, can you, make a money, make a payment to your margin account, because there is this margin call. Then you will get frustrated. You say, hey, why? Why you call me? I'm very busy. Okay. This is quite often, whenever people get called by the bank for the margin call, right? So margin call and for selling. Okay, again, I took the snapshot from Hong Leong Bank share margin financing product disclosure sheets. Okay, so for margin call, it will be triggered when the margin of financing is more than or equal to 65%. You will get call for a margin call. Okay, just bear with me with the numbers. Yeah, so for selling, it will trigger when the margin of financing is equal or more than 80%, right? Okay, I know you don't have a picture for it, so I have prepared the illustrations for you. Don't worry. Okay, so for margin call, we talk about it will trigger when your margin of financing is equal or more than 65%, right? So for example, today you have a total outstanding balance of 100,000. And assume today your collateral value dropped to 150,000. So let us do some calculations. Yeah, you take a 100,000 divided by 150,000, you will get 66.67%. This is your margin of financing. Now you will see 66.67% is more than 65%. It means that you are now in the margin call situation. Okay, so how these calculations work, let me just go back to the calculation parts. All right. So the margin of financing is equal to your total outstanding balance divided by your total collateral value. Okay, assuming that you are not pledging any fixed deposit or cash. Okay, I put it in a very simple terms. So the illustration can be easily calculated, right? So bear in mind. So remember the calculation. We use the total outstanding balance divided by the total collateral value. Okay, so let's come back to this one. So today your outstanding balance is 100,000 and your collateral value dropped to 150,000. So you just take these two amounts, 100,000 divided by 150,000, you get 66.7%. Now you are in margin call. Okay. All right. So remember just now when I mentioned about the four main components of share margin financing, the first one is the interest rate. So some of you might want to know, hey, how much is the interest that they charge to me and on what amount that they will charge me, right? So as you can see over here in the illustration, the total outstanding balance is 100,000. So your interest will be charged based on this 100,000. Okay. So for example, today the interest rate, for example, let's assume today's the interest rate is 5%. Okay, per annum is 5% on your 100,000. So if let's say you continue using this facility for a year, at least the interest charged to you will be 5,000. Okay, let's say it's 5% per annum, will be 5,000. But the calculation is not as simple as this. But I don't want to dig down into that because if let's say we want to calculate on the interest rate, then it will be quite troublesome for you all to take it today. Because I just want to share you with the concept, and the idea of how we can leverage on our share portfolio using this facility. Okay, so I'll not go so deep into the interest rate calculation, but just the idea for you, your interest will be charged on your total outstanding balance. Okay, clear? Right. Now, so this is margin call, right? So we talk about forced selling. Okay, so over here, the forced selling is when your margin of financing is equal or more than 80%. All right. So assuming your collateral value is now dropped to 120,000. Yesterday it was 150,000, and the bank call you, hello, Mr. A, you're now in margin call, all right? So you say, okay, leave it, leave it. I don't want to top up first. And then after today closing, suddenly the collateral value dropped to 120,000. Oh, so the calculation will be, you take 100,000 divided by 120,000 is 83.33%. You are now in the forced selling part. So tomorrow morning, your banker will call you up again. Hello, Mr. A. So sorry to tell you, your share margin is currently in forced selling. You have to make payment today. Okay, so we see, why margin call? They don't ask me to make payment immediately today. Not that urgent, right? But forced selling, they are so urgent. Why? Okay, as the name implied, forced selling means they force law. So if let's say you don't want to make payment, they will just sell all your shares by force. Okay. So okay lah, I just try to be drama a bit lah. But forced selling is because when you sign the agreement with the financing providers, there are a few terms saying that they have the right to sell your shares when you are in which circumstances or in which situation. Okay, they will list it down. So it's a thick agreement for you to sign, so that all the terms are inside there lah. Okay, so by the name it's forced selling, but they are allowed to do so. Okay, they are allowed to do so. Okay, bear with me. All right. Okay, sell all or parts. Okay, very good questions. Okay, I will answer this one because I'm in this part, right? They will sell part of it just to bring back your margin of financing to the neutral position. Which, for example, for this Hong Leong Bank one, right, the margin of financing is up to 60%. So if let's say they are going to sell your shares, right, okay, they will sell the amount that will bring your ratio, your margin of financing from 83.33% back to 60%. Now, it's a huge amount because as you can see now, your shares value is only 120,000 and you owe the bank 100,000, So they will sell a lot of shares, okay? So some shares, they will sell it. And, okay, some people might ask, okay, which shares they will sell it? Okay, which shares? Because if let's say you have a portfolio of 10 shares inside, which one they will sell it? Okay, they will choose the one with the highest liquidity. Okay, with the highest liquidity or those with the lesser value. Okay, this one I don't want to dig down so deep into the valuation itself. Okay, now just now I talked about the urgency of margin call and forced selling. So how do we top up? Okay, how do we top up to bring our margin of financing back, back to our original 60%? Okay, so for margin call, it must be settled within 48 hours. Okay, so 48 hours is a bit, vague when we mention about it. So how do we calculate? Okay, so if let's say today, okay, today is what day is today? Today is a Wednesday. Okay, today is a Wednesday, and this morning your banker call you up, say, okay, Mr. George, your account is in margin call today. Is a day one, so you must settle it within 48 hours. Okay, so the calculation of 48 hours is actually from today. Okay, so today is the day one, tomorrow is the day two. It's only past 24 hours, right? So if let's say you want for it to pass 48 hours, it means it will go up to day three. Okay, you get what I mean, right? I hope you get what I mean. Okay, so for example, today is day one. You receive the call from the bank. You say, okay, you are in margin call day one. So in 48 hours, so you can see tomorrow is 24 hours, and the day after tomorrow is 48 hours. So you actually have 3 days, including today's, to settle your margin call. But my suggestion for you is that settle it as soon as possible. Because as you can see, there are 3 options for you to top up for margin call, while for forced selling, you only have 2 options. Okay, so I would suggest you to settle it as soon as possible because, okay, some of the method might take time for the money or for the collateral to go into your facility. Okay, so there are 3 methods for margin call to be settled. First way is to top up by cash. Okay, second way, you can do it by top up the collateral, which means is either by shares, by cash, or by fixed deposit. Okay, and thirdly, you can settle your margin call by sell down the shares that you have in your share margin facility. Okay, so there are 3 options for you to do. Okay, so you might ask, how much do I need to pay down? Okay, don't worry, the banker will let you know the amount. Okay, they will give you the option. So for example, okay, this morning, I don't know why, like, okay, this morning they call me, okay, they say, Mr. George, today is margin call for you. So if let's say you want to top up today, you have to top up cash. Okay, they will give you a specific amount. Okay, you have to top up cash, let's say for example 100,000. And if you wish to top up collateral, then you can top up a collateral shares of 160,000 worth. Okay, just an example lah. Okay, and if you love to sell your shares in this facility, you need to sell at least 300,000 worth of shares. Okay, thank you very much. Okay, so these are the typical call script from the bankers. All right, so they will let you know the exact amount of the options of these 3 options for you. Okay, so for forced selling, okay, as the name implied, it must be settled on the same day. Okay, so if let's say today the banker call you in the morning, by today 4:30 before the market close, you have to settle it. If not, okay, tomorrow morning they will sell down your shares. Okay, tomorrow morning they will sell down your shares because they need to let today's market closing to see, to observe your ratios. So they will sell it tomorrow morning. So don't play with the banker whenever they call you. Hello, today is your forced selling, and then you say, oh, it's okay lah, we just wait for tomorrow. Okay, then tomorrow they might sell down your shares. Okay, so for selling, you are only allowed with 2 options. One is to top up with cash. Second method, you can do so by selling down some of the shares in your account. Okay, you can do so because you say, I don't want to let the bank sell my shares. I want to do it myself. So you go and sell down your shares today before they actually force selling all your shares. Okay, force selling your shares lah. Okay, as you can see in force selling, you are not open with the methods of top up with collateral. Okay, there is a reason why for selling they don't give you a option to top up with shares, especially shares or fixed deposit. Okay, why? The simple reason being, it takes time for your collateral to be pledged, to your facility. Okay, anyone here have experience transfer your shares from one trading account to another CDS account? Okay, if you have experienced that, you know that it will take at least 1 trading days. Okay, at least the fastest I have experienced, if this morning I signed the transfer form with my broker, the fastest I can see is after the afternoon market opening. Okay, this is the fastest. But if the admin they do the process slow, then only tomorrow morning or tomorrow afternoon you will receive the shares in your receiving CTS account. This is why the bank don't allow you to top up with shares if you are in a forced selling situation, because it might take time. And by today closing, if they don't see your collateral inside the account, they will consider you are not settling the forced selling. Then tomorrow morning, they will do the same thing. They will force sell your shares. So it's better don't take this risk, so they don't allow you to have this kind of options for forced selling. Okay, so I have a question here. So if I got 100,000 cash and bank offers 60% MOF, so I only have 60,000 extra trading limits. Okay, so for the cash part, right? Okay, I see most of the people will get confused with the numbers. Okay, so you remember whenever we talk about share margin financing, just now we talk about the trading limit, right? So you see, if let's say you have 100,000 cash with the facility, if let's say they give you a multiplier of 2 times, okay, so your extra trading limit is actually 200,000. Okay, it's 200,000. But bear with me, cash and fixed deposit is different, because fixed deposit is pledged to the bank and they give you interest. Well, if let's say you put in cash to the account, they will just deem it as the cash in your trading account. So they will give you additional 100,000. So you have a 200,000 trading limit. Okay, with 100,000 is your cash, and additional 100,000 from the bank. So this is the calculation for cash. You don't ask me why, because the cash is, they cannot lock your cash. Okay, because they cannot lock your cash. As simple as that, because they don't offer interest for the cash you put inside the bank account. So might as well they just utilize it, so that you are not charged with the interest. You get what I mean? Okay, so it's not you get additional 60% from the cash, because margin of financing calculation is not for the trading limit. It is only for the for the margin call and for the subsequent trading limit that you might have. Okay, now let us go back to this. Okay, so I have prepared a few illustrations for the top up, okay, for margin call on how it can be done, right? So for margin call, okay, we use back the same illustration just now. Now your total outstanding balance is 100,000, and you have a total collateral value of 150,000. Your margin of financing is 66.67%, and you are exceeding the 65% limit, okay, set by the bank. Now you are in margin call. So they call you up, they give you 3 options. Now, how you can do? First option, you top up with the cash. So when you top up cash 20,000, it will go straight to offset your outstanding balance. So now you have 80,000 outstanding balance left, with your collateral value stand at 150,000. And you have successfully bring down your margin of financing from 66% to 53%, and you are safe. So this is the first method that you can do. Everyone clear? Okay. The calculation, don't ask me again. Okay. I mentioned just now, the margin of financing is using your outstanding balance divided by your total collateral value. So if you top up cash 20,000, it will offset your outstanding balance by 20,000. Okay. So now you are safe. Second option, if you choose to top up with shares worth of 20,000 collateral value. So now you didn't bring down your outstanding balance. Instead, you bring up your collateral value from 150,000 to 170,000. So as the calculation goes, you are now safe from 66.67% margin to 58.82%, and you are safe for margin call. Okay, so this is the second method that you can do so. All right. Now, third method, okay, when we talk about sell down your shares. Okay, so for example, you say, okay, I want to sell down 40,000 worth of my collateral. So you sell down your shares, and it will bring down your collateral value from 150,000 to 110,000. And after you sell these shares, right, this 40,000, the bank will receive from your broker. So they will use it, the cash, they will use the proceed to offset your outstanding balance. So it bring down your outstanding balance from 100,000 to 60,000. Okay, but remember, there are stamp duty, there are stamping, there are brokerage charge, occur, during the transactions. So the exact amount might not be 40,000. It might be 39,000 or 38,000 plus, depends on your brokerage rate. By the way, anyway, it will still bring down your margin of financing from 66.67% to 54.55%. And with all these 3 methods, okay, you are now safe for margin call. Okay, so it means that the bank will not sell your shares. Understand? Okay, and you won't receive call from the bank anymore tomorrow, unless the collateral value drop again, okay, after today's closing. All right. Now, after we have top up for margin call, then let us move on to top up for selling. All right. So just now, as I mentioned, there are only 2 options or 2 methods that we can do, which is top up or to sell down shares. So as simple as that, if let's say you top up cash of 30,000, it will offset your total outstanding balance by 30,000. So now your margin of financing is 58% instead of 83%. Okay. So if let's say you sell down your shares worth of 65,000, it will bring down your total collateral value by 65,000, while it will also offset your outstanding balance by 65,000. Okay. So now you have bring your margin of financing back to 63.64%. Now, you will see why I didn't bring it down to 60% or below that, right? Because 63.64% is also within the buffer, because just now when we mentioned about margin call, it is equal or more than 65%. If let's say you bring it down to 63%, you're not in margin call situation today also, right? So they won't call you, but you don't have any more trading limit for you to trade tomorrow. Okay, so that's a very simple one. So the calculation all done. Here goes with things to watch out when we use share margin financing. Okay, there are 5 things that we need to watch out. Okay, because this is not a simple financial product, financing product. It is quite a complicated one, and if you don't know how to use, it is a risky one, right? So first thing that we need to watch out is the collateral value. Okay, every financial, they have a different valuation for each and single counter of the shares. Okay, so for example, okay, I don't want to mention the name of the shares okay, as the disclaimer goes by, right? So for example, stock A may have 100% valuation from bank A, but for bank B, maybe they say, okay, this stock is not that liquid, or it's not that good fundamentally, or in whatever area of calculation that the banks deem necessary. So they might say, okay, this stock A, I only give 80% of the valuation of the market value. So you see, the collateral value is not necessarily equal to the market value. Okay, so bear in mind. Okay, bear in mind, the collateral value may not be equal to the market value. Okay, as simple as that. But don't ask me how to calculate it, because it's very complicated, and I'm not sure whether you can master it today. So if let's say you're interested, maybe you can you can learn it elsewhere. Okay, now second things to watch out, changes in interest rate. Okay, because right now we are in the rate high circle, so the interest rate might increase, so the cost of share margin financing can get higher. Okay, so changes in interest rate will also have a significant impact to your share margin financing. Okay, now thirdly is your margin positions. Every financial, they have a different margin requirement. So for the sample that I showed just now is from Hong Leong Bank. Okay, and okay, it's only at the point of time that I took the snapshot. So they might change the margin requirement as well. So you need to know every financial, they have a different margin requirement. Some, their margin of financing is maybe up to 55% only, or some may even lower than 55%. Maybe they only give you a margin of 50% only. So every financial has different margin requirement. Bear in mind, you have to watch out for your margin position. Okay. Now, fourth thing is the rollover fee. Some financial, they may impose a rollover fee on your outstanding balance after a certain period of time. Okay, so what is rollover fee? That means that you are carrying your outstanding balance, the loan, for a longer time. Okay, so for loans with the bank, the longer you have the outstanding balance, the riskier the bank is, because they are exposed to this default risk. So for them to have a better a margin in terms of the loans that they give out, they need to charge you some fees on that. So they will charge you certain percentage on top of your original interest rate, and the additional interest, we call it as a rollover fee, right? And the fifth thing is the documentation fee and stamp duty. Okay, because it is a form of financing, so they are a documentation, and they require legal fee and stamping. So there might be additional fees whenever you're applying for a share margin financing facility. So these are the 5 things to watch out whenever you are considering taking up share margin financing for your share portfolio. Now, these are a few things that you can do when you're trying to utilize the share margin financing. First thing, invest in good companies that generate dividend income. Because why? For good company, okay, the bank might give a better valuation. Okay, this valuation is in terms of the collateral value calculation that I mentioned just now. So good company tends to have a higher valuation. Okay, ask me to go back to the previous slide. Yes, okay, I give you 3 seconds. 3, 2, 1. Okay, now let me just move on with that, right? Okay, so if the company have a higher valuation, that means that you can leverage more on it. And if they can generate dividend income, it's also better because it can help you to offset your outstanding balance bit by bit, because the dividend income is additional on top of your cash investment. So this amount can help you to offset your outstanding balance. Second things, you can, or I will suggest you to maintain your margin position 10% or 50% below the requirement to provide a safety buffer, in the event of market downturn. As we all can recall, during 2020, the MCO, the COVID-19 hit us, the share market dropped tremendously. So to give us a safety buffer, we touch wood, we don't want to have the COVID-19 again and the market sell down again, right? But to give us a more safety buffer, I would suggest you to maintain your position 10 to 15% below the requirement. For example, today, if let's say the margin requirement is 60%, then I would suggest you to lower it to maintain your margin position to somewhere around 50% or 55% or 45%, to give you some buffer. Okay, all right. Now, thirdly, you can use share margin facility as a backup in the event of market bargain sales. It can be as a backup or a standby facility for you that you don't need to use it now. But whenever you see there is a market bargaining sale, some value stock, they just drop in terms of share price, and you think that, oh, this is the price that I wanted to get in, then you can use the share margin as a backup, because it might happen whenever the market is having a bargaining sales while you don't have enough trading limit to buy the shares. So you may use the share margin facility as a backup. But bear in mind, you need to apply the facility earlier, because the whole application process might take up to a month. So yeah, so you need to prepare it first, beforehand. And fourth, you can make regular payment to bring down your outstanding balance, even you are not in margin call. Why? Because we want to reduce the interest charged by the bank. Okay, the interest might be huge. The interest charged to you might be huge. If let's say you have a large amount of outstanding balance, so it's best that you can make regular payment. It is not forced by the bank to make fixed payment, but you can do so, and I strongly advise you to do so, for your safety. All right. And what you don't do, okay, what I will suggest you not to do is use share margin without the understanding of the potential risk. If you don't know the potential risk of using share margin financing facility, don't use it, please. Okay, because it is a double-edged sword. Okay. Now, second thing, I don't advise or suggest or recommend you to trade penny stocks or shares that have zero collateral value, to your margin facility. So how do we know that if these shares have a good collateral value or a lower collateral value? You can always consult with your banker or your dealer or your remiser. They will have a list of the valuations. Okay, so don't trade it, because if you eat up your margin position, and it will not add value to your collateral value. You get what I mean? Now, and thirdly, I don't suggest you to use the facility too aggressive. Okay, so do not push too closer to the margin limit. And the fourth one will be, don't use the margin facility as the contract account. Okay, they are two different facility. Okay, they are two different facilities. So don't use it as a contract account. Okay, you can apply a contract account with your broker, but don't use share margin financing as a contract account. Now, the last point that I don't suggest you to do is to pledge all your available shares portfolio into your share margin facility as collateral. Because you always need to maintain some good good amount of shares in your cash trading account, just to prepare for you whenever you are in margin call and you don't have enough or sufficient cash to top up for it. You may transfer some of your shares from your cash trading account to be pledged into your margin account. So don't put all your shares into the margin account as a collateral at first. Okay, so these are the do's and don'ts for share margin financing. Now, these are the I think the slides, okay, that everyone is waiting for, which is how can we apply? How can we apply for share margin facility? If let's say I want to do so. So first thing I will suggest you to understand your leverage power. Okay, so how do we understand our leverage power? You ask yourself two questions. First thing, how much you are eligible to and how much you are comfortable with. Okay, how much you are eligible to is depends on the bank, because they will study on your debt service ratio, and then they will know, okay, you are okay with, let's say, 100,000 facility or a 200,000 facility. But it doesn't mean that the bank allow you to do so, okay, but you are not comfortable with. Okay, but you're not comfortable with. So it's best that you are taking the facility at your comfortable level. For example, the bank can offer you up to a 500,000, but you think that is a quite huge amount for you to take in. So you say that, okay, I only want 100,000 facility. That's all. I don't want to take so much, right? So you can do so, all right? And get ready with the income documents. Okay, the tips here is the more the merrier lah. So prepare your IC front and back, the latest 3-month salary slip with a latest 3-month bank statements. If you can prepare up to 6 months is best, and also a 3-month Bursa statements, for them to evaluate on your share portfolio. And last, your latest 2 years income tax filing. Okay, it's either in EA form, B form, or BE form. Okay, the more the merrier. Some banks, they might not ask for all this, but if let's say you prepare more, then it's best for the banks, to evaluate your application and to fasten, the application process. And last, make the right choice. Make the right choice. Compare whether you want to use an internal margin or an external margin. Okay, and also compare the interest rate offered by different financial, because you will find it interesting is that the interest rate differences, different from financial A, financial B, financial C, financial D, and the differences can be quite huge sometimes. So do your own survey and do your own due diligence before you apply for a margin facility. And last but not least, make the decision using the collateral valuation. Okay, always goes to the financing providers that offer a better valuation, because this can ease your investment process using share margin financing. Now, okay, so these are the application process. And in summary, okay, today we have discussed about the different types of share margin financing facility available in Malaysia. Okay, and also we understand the 4 main components. Okay, which let me recap again. The 4 main components. The first one is interest rate. Second one is margin of financing. Third one is margin call, and the fourth one is the leverage, okay, the multiplier. Okay, now thirdly, master the key calculation for share margin financing. Just now I've shared about margin call and forced selling. How do we calculate for it? And the do's and don'ts I would suggest whenever you are using it to leverage on your shares portfolio. And fifth, steps to apply. Okay, I've shown you the steps just now. And last but not least, okay, always continuously monitor your portfolio and monitor your margin position to make sure that you are in a healthy position and you are not being forced in margin call or forced selling. All right, so these are the summary I have for today's, and I hope that my sharing can give you a better understanding on share margin financing. And if let's say today is the first time you heard about this, it might give you a better selections or a better way, for you to leverage on your share portfolio. All right, so with that being said, thank you everyone for spending your time here. I'll pass back to our moderator, Shane, for the Q&A sessions. All right.
All right, thank you so much, George, for an enlightening session about share margin financing. I think it involved some formulas, so hope that you guys grasp the formula and understand the logic behind. If you have any questions to ask our speaker George today, please write your question in the Q&A box. Okay, don't write them in the chat box. Write them in the Q&A box. The first question is, how is share margin financing different from the collateralized account that is offered by the broker?
Okay. All right. Good question asked by PK. I think it's PK, right? Okay. By our attendance today. So share margin financing account is different from collateralized account. Is that share margin facility is a facility, while the collateralized account is an account offered by the brokers. So the collateralized account is something like your contract account. Okay, it's something like a contract account. So it is a two different facilities. Okay, so they are different by the function of it. Okay, and by the mechanism of it. All right. I hope I understand the question.
Okay, so what if, after you receive a margin call from your financier, then suddenly the price of the shares collateral make a strong rebound? And then is the margin call still valid? Do we need to top up the cash?
Okay, good question. These are the questions that often asked by the investor whenever they are being called by the banker. You are now in the margin call, so they say, okay lah, I think today my shares will rebound. Okay, I think my share will rebound. Okay, but is the margin call still valid? Okay, if let's say this morning they call you up and you choose to do nothing. Okay, you think, okay, today the market will rebound, and indeed it rebounded. Okay, after the market closing, then the bank will evaluate the calculation again by the closing today. So if let's say today closing, your margin ratio is being bring down to less than 65%. Okay, assuming that 65% is the margin call ratio, and it is being bring down to lower than 65%, then the margin call is no longer valid. Okay, then the margin call is no longer valid. So tomorrow you will not receive any call from the bankers. Okay, so you consider being neutralized by the performance of the shares itself. Okay, and you are safe. Thanks God, you are safe.
Yeah, because we have 48 hours, right? So some investor will
yes.
wait for 48 hours if on the day 3 only start the top up.
Correct. But bear in mind, because you are waiting for a market rebound. But if let's say the market don't want to rebound and it drop further, then you might have to top up even more, and it is quite urgent if let's say you have a tight cash flow in your position.
Okay. So just now you mentioned that, for instance, the snapshot you took from Hong Leong Bank, that the forced selling is at 65% or more. So if after 48 hours, you don't top up, you don't cover the margin call, and the MOFs remain at about 70%, but not exceed the forced sell threshold, will the bank still have you to force sell?
Yes, correct. They will still help you to force sell because they already give you a grace period of 48 hours, but you don't want to do that. And you are still in a margin call. So they will force sell your shares as well. They will force sell to bring it down to 60% or bring it down to the margin of financing that they offer.
Okay. So the next question is, how is interest rate charged? Yeah, is it daily rest? Like every day your outstanding balance will increase a bit?
Okay, yes, it is a daily rest interest calculation, but it will only be charged to your outstanding balance on the monthly basis. Okay, so the calculation will be they charge on your daily outstanding balance, but they don't add it into the outstanding balance every day. They don't compound it on the daily basis, but they compound on the monthly basis, but they calculate on the daily rest. You are right in daily rest, but they compound in the monthly basis. Okay, I hope it answer the questions.
Okay. Yeah, out of curiosity, I'm a math student, right? Let's say I take out a SMF on day 1 on the month 1. Okay.
Okay.
And it is 100,000, and the month has about 30 days lah. So on day 30th, I clear off all my outstanding debt 100,000. So will my statement still show interest or not? Before
Yes,
the
it
man
will still so
ends,
because they are calculated on the daily
so
basis.
because for 29
Yeah.
days I have an outstanding balance, so it will be
Correct.
charged on for the 29 days I have the outstanding balance lah.
Correct.
Okay,
Correct.
understand. Any restrictions on the use of share margin financing? Is it on certain shares or warrants? That's by Peter.
Okay, so in terms of restriction use, yes, there is, okay, but it is different from, it is varies from different financing providers, okay. So some providers, they might restrict, for example, today, if let's say you are the director of this company, of this listed company, they might have a restriction that saying that you cannot pledge your own company shares to the financing facility, okay. They might have restriction as in you are the director, or some financing providers, they have restrictions on some purchases. So for example, as we know, there are warrants being offered in Bursa Malaysia. There are a structured warrant being offered in the Bursa Malaysia, or even ETF being offered right in Bursa Malaysia. So some share margin financing may not, cover for your trading of ETF or structured warrant, or even the company warrants. So you have to, talk with the banker to find out, do they allow you to trade this kind of thing, or is there any restrictions on the facility itself? So it varies among different providers. So I cannot answer you for all.
Okay. Peter Ling would like to ask, why do I need to apply for the margin money since I invest the share using my money?
Okay, good question. As I mentioned just now, it can be a backup for you, and the benefit of using share margin financing can increase your ROI. Because imagine if today you have 100,000 worth of cash, and when you invest you put all your cash all into the share market, you can only buy 100,000 worth of shares. But if today this 100,000 worth of shares, you pledge it with the bank can give you additional trading limit to trade. So for example, you utilize 50,000 of it, you are now having a share portfolio of 150,000, but you're only using a cash of 100,000. Don't it sound amazing to you? Or do you find the differences, using your own cash or using the share margin, right?
Yep. It's like if you have 1 million ringgit, you could actually buy one property using cash, for example. But if you take
Correct.
mortgage, 1 million ringgit probably can buy 10 properties. If you take
Yes, you are right.
margin of financing from the bank.
Correct.
Yeah. So it depends, okay? But of course, share margin financing is a banking facility. It comes with leverage, so must really use it with caution, like what George say, right? Buy stocks which give high dividend yield, so they can offset the interest rate charge, and can command a higher collateral value lah.
Yes.
Okay. Thanks, George, for sharing that. So how is the trading limit offered by SMF different from the trading limit offered by the collateralized account?
In terms of the trading limit, I actually never go and compare with the collateralized account, because in fact I never use one of the collateral account. So I don't think I am suitable to answer for that. But for collateral value, the trading limit is being calculated as I mentioned, as I shown just now, the calculations. Okay, so if let's say you have more ideas on collateralized account, maybe I can give some time to research on it, so I can have more understanding of it. But today I don't have much information on hand to answer for that.
No problem. Yep. Is it common for financiers to raise the margin of finance in a bull market and cut the margin of finance in the bear market?
Okay, it is a very good question. So based on my understanding, the bank don't really raise or cut the margin of financing anytime or during any type of market, because the margin of financing is actually fixed when they offer you the facility, and it is being written down in the agreement that you sign, and also signed by the bank and stamp it. So they cannot go and increase the margin of financing in the bull market, or they go and cut your margin of financing in the bear market for your facility. But it might happen if let's say they are offering for a new facility, then yes, they might raise the margin of financing when they deem necessary for a new facility, but not to your existing facility.
Yeah. So they often adjust the margin of finance for the new facilities depending on the circumstances in the market, right?
Not really. In this market, they don't really, because 60% or 55% is considered quite
Common.
a balance for them, optimum, yes. So I don't see any financial institution doing that quite often these days.
Okay. What is the typical interest rate charge for this facility?
Okay, well, very good question. Okay, before I go and do research, let me give you some brief idea on this, but you can always go and do your own research, yeah? So for the interest rate being charged by external margin providers, okay, just now I have mentioned who are the external margin providers. You can just refer back to it, right? So the rate is often around 5 to, at this moment, because the standard base rate has been increased by Bank Negara. So at this moment, they are charging about 4 something to 5 something. Okay, these are the rate being offered by external margin. While for the internal margin, as we know that they are not a commercial bank, so stockbroker, they often don't have a huge, cash stronghold as compared to a commercial bank. So they might charge higher interest on that. So the differences will go about 4% to 5% compared to the one being offered by external margin. So for example, if let's say the external margin charge on 5%, then the internal margin or the stockbroker, they might charge around 7 to 8% per annum for the facility, and it varies among different stockbroker. Okay, so you have to find it out yourself lah.
Oh, that's a big difference,
Yes,
yeah,
because
4-5% to 7-8%.
correct, because they don't have a strong,
Okay.
cash from the depositors.
Okay, let's say I'm a investor with Hong Leong e-broking. Okay.
Okay.
Okay. Should I take the SMF from Hong Leong Investment Bank, or should I take it from Hong Leong Commercial Bank?
Okay.
Hong Leong Bank.
So if let's say the interest rate being charged by Hong Leong e-broking is somewhere near to Hong Leong Bank, then I would suggest you to take it from Hong Leong e-broking. Okay. But this is in terms of the perspective of interest rate, but you also have to take into consideration of the valuation that they offer compared to Hong Leong Bank, because they are two different entities. So Hong Leong Bank might offer 100% value for stock A, but Hong Leong e-broking might offer only 80%. Okay, it varies. So we have to take into consideration of a few things before we make our decision.
Okay, that's very interesting. So even though within the same Hong Leong group, there are also two different entities that can offer you the share margin financing. But I suppose many of the other commercial banks, like like Maybank, RHB Bank, right, also have the investment arm, right? But why don't these two other commercial banks offer share margin financing? But only Hong Leong and Alliance Bank offer share margin financing.
Okay, first of all, I don't think I can answer on behalf of the management of the banks. But as I know that last time, Maybank and RHB Bank, they do offer external margin, but they decided to keep it for themselves. After all, I also don't know why. Maybe they find that the market is not as good as internal margin, or maybe they find the market is too competitive, so they decided to let go the market share. Yeah.
So Richie would like to ask, which are the financial provider that provide SMF without record in secrets or CTOS? I think that will refer to a more internal provider, right?
Yeah, it is always with the internal providers, because for a commercial bank, they must put your record with the secrets. So the external margin, for sure, your share margin facility will reflect on your secrets or your CTOS. But for internal margin, for those that are offered by stockbroker, some of them can do. Okay. So if you ask me which one of them, I would suggest you to talk to your broker or to talk to your dealer, because as I know, there are a few or not only one, but a few that can do so. Okay, but I don't want to mention names, so you can go talk to your dealers.
So if we take share margin financing from an external provider, say Hong Leong, and we are using, let's say Kenanga or CGSMB, they are different from the external providers. Will they have delay in the information feed from the broker?
Yes.
Like
yes.
if I take internal source, then probably the system is synced, right? They can know immediately it has reached margin call status. But if I take from external broker, will the broker have delay, and how delayed it is to receive this information from the broker?
Okay, yes. So there will be delay. So for external margin, or we call it a third-party margin, right? The delay will be a day. So for example, today, all your transaction, the external or the third-party financier will only receive it after the market closing. So the delay is 1 day. Okay, if it's the whole market day. So today, if let's say they give you a trading limit of 1 million, that's all that you can trade for today. Okay, they won't reflect whether if let's say you sell the share or you buy more share, right? Then they would just do the calculation based on this 1 million. But if let's say you are using internal margin, your trading limit is synced immediately. It's synced immediately. So whenever you buy the shares now and the transaction, the order is being filled, then you can see your margin position right away. So there's a 1 day delay in terms of the data.
Understand. So can we use share margin financing to apply for IPO or private placement?
Okay, good question. For IPO, if let's say you want to subscribe, you cannot do balloting. Okay, if let's say you want to apply through balloting, I'm so sorry, you cannot do so, because for share margin facility, the CDS account is not directly under your name. It is collateral. It is the share margin account is not directly under your name. We call it a what name we call it again? We call it sorry, I can't remember the name now. But if let's say you go to the listed company annual report, you go to the top 30, you always see that some people have their yes, the nominees account. Yes, thank you. So the share margin facility, your CDS is always with nominees account. And bear in mind, nominees account, they don't allow you to apply for balloting. Okay, they don't allow you to apply for balloting. So you cannot apply for IPO unless you get a private placement from the listed call itself. Then you may be able to use your facility to buy the IPO or for the private placement. Okay, but these are different story which I don't cover it today, because it will be utilizing the cash portion, the cash drawn portion from your margin facility, which I didn't mention it today. So you can do so, but the steps will be quite complicated.
Okay, so let's do one last question. Can you talk about haircut?
Okay, so I think this person who asked this is quite familiar with share margin, because he know about haircut. So the haircut is not a simple haircut that we do the hair, we cut our hair. So haircut means that the financing provider cut the valuation for particular stocks. Okay, so this haircut often occur when the fundamental of the company change tremendously. So for example, this company suddenly from profit making to a loss making, and the future prospect of this company are totally gone. So the financing provider, to protect themselves for the default risk, they might haircut the shares. For example, today they give 100% valuation for this stock. Suddenly some bad news happen, this company fundamentally change, and they might haircut it to a 50% valuation. So for whatever shares that you have in your holdings, right? Initially they evaluate at 100%. Now they only evaluate 50%. So if you change your margin of financing, and your margin, it might trigger margin call or for selling immediately whenever there is a haircut in the market. So this thing also we need to be aware. So I categorize this under the valuation when I mentioned the 5 things to watch out.
Yep. So that's when, like, what happened in the glove decline. Then I think some banks did haircut on the glove
Correct.
counters. Okay.
Correct.
So a lot of margin players have to deal with the margin costs, because the share price come down already, hit them enough, then still have to kena the haircut. So at the end of the day, right, the glove rarely stop lah, and the share price crash a lot, as a lot of people have to cover back their position.
Yes.
Yep. So let's conclude our Q&A session. So thank you so much, George, for sharing with us share margin financing, leverage or stock portfolio share margin financing. Hope all of you here have learned a great deal on how do you use this facility, when to use it, what are the things to watch out for when you want to use this facility. All right. Thanks, George.
Okay. Thank you, Shen.
So for our next webinar, it is titled How to Master Macroeconomic Analysis as a Trader. So it is happening on tomorrow morning, okay, 11 May 2023, 10 a.m. to 12 p.m. So I've just given you the registration link to register for the session. If you want to learn how do we use macroeconomic analysis as a trader, okay, how to use it to aid our trading decisions, come and join the webinar tomorrow morning. So with that, I want to thank all of you here for staying tuned until the end of this session. Hope you learned enormously. And again, a huge thanks to our speaker today, Josh Poe, for sharing with us the knowledge about share margin financing. So see you guys in the next webinar. Bye, everybody.